Welcome students, good evening. I hope you have revised the last session properly because we dealt with many questions around transfer pricing methods. Have you or have you not? No problem, Purushottam, but I hope you are very clear with the concepts. Yes, good evening, Viraj. Good evening, Kaushiki. I assume that you have revised it, Purushottam, and you are clear with the concepts. Okay. Any questions, particularly with respect to the last lecture? Purushottam, the application of TT method, we choose transaction-wise and not entity-to-entity-wise. Very good question. We choose for each transaction because let's say, for example, I have interest on loan for which a cup is available. And then for, let's say, for example, sale of goods, I will be then using the resale price method. So it depends on the transaction to transaction and it's not fixed like entity-wise. Okay. Viraj, you should be revising. Please revise tonight after today's class. Do not miss revising. It's very important to remain connected with the class. Okay. Any which ways, what I'll do is I'll quickly revise for the students. So what we have done in the last class is the methods of transfer pricing. In the methods, we had the traditional methods and then we did the transactional methods. For the traditional method, we have the cup. Cup is very direct, make the comparison of the pricing. Then you have the RPM, which is the resale price method. In that, you compare the gross profit on the sales, right? So you first start with the arm's length gross profit of the independent party. You apply it to the sales of your third party sales, which you are doing to find out the purchase price from the associated enterprise. So this is applicable where the entity is into the reseller or is a reseller of goods without making any addition. Then cost plus method is applicable for the service sector, for the manufacturing, where you are making the sales to the related party, right? Sale of services or sale of goods. Then you start with the arm's length cost plus markup, which is gross profit upon cost. You apply it to your cost and then you find out the ALP sales, right? And then we did the transactional method, which is the TNMM method. Why? Because the direct methods may be more susceptible to the accounting changes. So here we use the term operating profit, right? And therefore, we did this particular TNMM method as the method of last resort, right? We understood that it's a method of last resort. When any other method may not be working, we may go with the TNMM. In that, you have the numerator as your operating profits and your denominator will be sales or cost or whatever denominator you would want to compare, because this is a very, very flexible method. If you are a reseller, you would take the denominator as sales. If you are a service provider, you will take the denominator as cost, right? So this is how the methods we have done. We have one more method which we are going to do now. Purushottam, okay, I will explain the TNMM again. So as I said in TNMM, this is a residuary method. As I said, here you can use the net. It's same as cost plus or the RPM. The only difference here is that in cost plus or RPM, you take the gross profit. Here you take the operating profit. You do the operating profit upon the denominator. In case you are a reseller, then your control transaction is the purchase. So you will take the denominator as something which is uncontrolled. So if you're a reseller, you will take the denominator as sales. In case you are a service provider, you will take the denominator as cost because your sales is a control transaction. Now, why this is a residuary method? Because in RPM and CPM, we are using gross profit. If you are using gross profit, then it is possible that you may not find the gross profit of the independent enterprises very readily. Also, it is possible that there may be accounting differences because of which the gross profit gets impacted very easily, because somebody may take the warranty in the, let's say, P&L, somebody may take it in the trading account. So there may be accounting differences because of which the gross profit would get impacted. So therefore, we take the TNMM. Practically, most of the time, we use the transaction net margin method as the method for calculating the transfer pricing. We do use RPM and CPM, but most of the time it is a TNMM which we use. Okay. Yes, there's another question in example number 2 of CPM method. Interest on loan provided by the AE is added to the cost of the project. If it does so, what if interest on loan from outsiders less than the interest charged by AE1? Is it shows appropriate calculation of ALP? And if loan from outsider, it will affect the cost of the project of the unrelated party accordingly. Is it so justifiable to make adjustment for loan from related party AB? Which example you are mentioning, Purushottam? Is it this example? Are you mentioning about this one where we have made the adjustment for the interest on loan? Here we have made the interest on loan adjustment because here if you see, here it is clearly provided that the AB INC has provided loan to Anant towards purchase of software for executing its project with the rate of interest is 3% per annum. So what I've done is I've added to the cost, right? Now, in case you have taken the, let's say, for example, loan from the third party also, then also you will add it because here you are identifying your cost on which you are adding your markup, isn't it? So that we would any which ways do. Are we clear, Purushottam? Yes. Then, ma'am, illustration 3, cost plus method. In this question, cost of credit is calculation is different from our class calculation. You mean in module, Mansha? In module, you are saying it is different? 1 second, let me see. Let me just open up the module also. We have to present the RSP method as it is in study material, or I didn't define. Sure, Purushottam, you can present to me how you have done that. Somehow I'm not able to open up the module. Give me a second. I think the internet is working. You're able to receive my voice because let me see. There seems to be some problem. Are you able to open up the module on the website? Because it's not opening at my end. No, I'm not able to open up the module. Okay, we'll take up that question, Mansha, later if at all it gets open, because I'm clearly not able to access the module online. In case you're able to open it, just let me know because it's not getting downloaded. There seems to be some issue. Okay. Now, next method which is there is the profit split method. Okay. Mansha, I'll answer your question once the module gets open. Next is the profit split method, PSM. Now, what is this method exactly? Let's try and understand. So, this method which is there is a two-way method. All the other methods you saw were one way. Ma'am, we are not able to understand one way, two way. What are you trying to say? I'm trying to say that, see, when you are identifying the arm's length price, we are looking at one of the party, which is, let's say, for example, if I am providing the services, so I'm computing the ALP of mine, isn't it? I'm not looking at the ALP of the other enterprise who is purchasing the goods or procuring the services. So, if I'm, let's say, for example, taking out the ALP, whose ALP you're computing? The one who is Indian entity. I'm not looking at how the non-resident entity would compute the ALP because it will also have to compute. If I am using RPM, they might be using CPM or TNMM, isn't it? because they also have to calculate the ALP of their purchases if I am making the sales. And in that country, the comparable ALP might be very different than from what I have. Right? Now, all of these methods, the RPM, CPM, TNMM, requires that there is a comparability between the transaction, the functional comparability. Whereas it is sometimes possible that the transactions between the multinational companies are so integrated that it is not possible to find out a comparable transaction altogether. Let's say, for example, there is some unique transaction. Let's take example of Google. Let's take example of Starbucks. These are some of the monopolistic companies which are operating where it is very difficult to find out their comparable transactions as to what they are doing. Or let's take a very recent example, ChatGPT. Have you heard about it? This is the new AI where you can ask any questions to them and they are answering it really well. This is by Microsoft. The ChatGPT is a tool by Microsoft, which is, I think, in the future going to replace Google also. Because if you ask any question, even if you can try asking a transfer pricing question to them, or you can try asking the methods of transfer pricing, it may answer very well, sometimes better than you and me also. No, Mansha, it's not a language translator anymore. It's more than that. You can ask any question. You can ask CA final question. You can ask them question. They would at least answer something. Now, this is something which is very unique. Does ChatGPT has a comparable? The answer is no. So therefore, the transactions might be so integrated that we may not be able to find a comparable transaction. Or there could be many multinational companies in the group, all of which may be adding value at some or the other point. See, when you are using RPM, when you are using CPM, the entities are not really adding any value, aren't they? When I'm saying RPM, it's a pure distributor. It's a pure distributor without adding any value to the goods. If it adds value to the goods, you will not be able to use RPM. Good evening, Geeta. So therefore, what happens is that the transactions might be so complex that each party to the transaction might be adding certain value. And therefore, in that particular situation, you may not be able to use the TNMM because it's a one-sided method. It's a one-sided method. Or let's say, for example, there is involvement of the intangibles. There is involvement of the intangibles. So therefore, in that particular case, what happens is that these intangibles results in unique value addition. And because of which, you may not be able to use the TNMM or RPM or CPM method. So therefore, we have the profit split method in place. Now, what is the profit split method? The profit split method which is there, it calculates the contribution of each entity. It calculates the contribution of each entity and determines the profit to be allocated. Remember, we had done in section 92. Section 92 also covers the mutual agreement or arrangement between the two or more enterprise for allocation or contribution to any cost. Remember the example I had given you at that point in time, that the software cost is allocated between different enterprise. How do I determine the profit which is attributable to each enterprise? I cannot use TNMM in that particular case. So therefore, I have the profit split method. The profit split method will allow me to split my profit based on the contribution from each enterprise. So the relative contribution of each entity or each associated enterprise is determined, which the contribution which they have made to earn the net profit. To earn the net profit. And the net profit is divided or apportioned based on the relative contribution. Are we clear? So the net profit is split amongst the enterprise in proportion to their relative contribution. Are we clear? So let's say, for example, there is AINC and it has subsidiary in, let's say, 3 countries: China, Bermuda, India, and this is in US. Now it has, let's say, for example, earned, say, $1,000 net profit. Now here, let's say this entity is a specialized entity in manufacturing, a very specialized entity. Here, this entity holds the intangibles. And here, this entity is a reseller, but making the value addition. So the sales which are made by the US entity have the contribution of each entity. So what you will do is, you will identify how much Chinese entity is contributing to $1,000. You will say, how will we identify, ma'am? You will look at the comparable manufacturing entities as to how much profit they are generating. Let's say based on that, you come to the conclusion that it should be $200 which should be given you. You will allocate here. Now this entity is merely holding intangibles. It is not performing any function as such. So you may just allocate 100. But this entity, let's say it has a lot of intangibles in terms of customer list, database of customer, marketing skills. So you will allocate, let's say, 500 over here. And balance, let's say you will allocate here. So this you will identify based on the functions it is performing, based on the asset it has, and you will compare it to the market data. So this is how the profit split method works. Are we clear? Any questions so far? Any doubt, any question? Yes. Good evening, Jacob. So this is the profit split method. Yes, Purushottam, your question is, if lower interest on loan was available from outsiders, why AE get loan from AE? In this case, adjustment of interest is to the cost of project is relevant. See, if lower loan is available from outsiders, then you will also make the adjustment to the interest. You will take the arm's length interest. Here we have assumed that the interest is already on the arm's length, and therefore we are not making any adjustment. In case the lower interest is available, then you will certainly make even adjustment for that. Clear, Purushottam? Yes. Mansha, I have opened the module. Which question you were referring to? Illustration 3, cost plus model. Yes, in that, the cost of credit calculation is different from our class calculation. In this question, for the cost plus, you mean this one, right? What is the difference if you can identify to me? The difference may be due to, Mansha, this was 2% of the In the module, if you see, it was LMN offered 1 month credit. The cost of providing such credit may be valued at 2% of the gross profit. Whereas in my example, if you see, it is provided that, where was it? 1 second. 2% of the normal billing rate. So I have taken 2% of 100, whereas there they have taken 2% of 50. So that is the difference, Mansha. Is it clear, Mansha? In the module, they have taken the 2% of the gross profit because the question itself provides that. But here in my question, I have taken the 2% of the billing rate, and billing rate we are assuming to be 100%, right? It's not assuming, but billing rate is obviously 100%. So I've taken 2% of that. Is it clear, Mansha? Yes. Okay, perfect. So now we have finished all the methods. Fine. Now tell me one thing. How will you select when an exam, let's say a question is given to you, or let's talk about the real life scenario. When you are given, let's say a client is coming to you. Now you'll become CA, okay? You have become CA. This June, you will be CA, right? And you will start taking up clients. You have started your own practice. And you tell your clients now, oh, I know transfer pricing. So you please give me the transfer pricing audit. So he will come to you. Let's say a reseller is coming to you. You will say, oh, I know. We have learned in CA final that if you're a reseller, we will apply RPM. So you do the transfer pricing audit of that client. Let's say another client comes. Now, in this particular client, you observe that he is providing the services to the associated enterprise. Now you're confused between cost plus, TNMM, or profit split method. What do we use? So how will you decide? You have become CA. How will you decide which method to use? Yes. All the chartered accountants, yes. How will you decide which method do you adopt? So for that, you have to take into consideration several factors. It's not an easy answer. You have to determine, before selecting a method, you have to decide which is the most appropriate method. Which is the most appropriate method. Because let's say, for example, if you are selecting a method, why do we say it's most appropriate? Because it may be appropriate according to you, but may not be appropriate regarding the according to the transfer pricing officer. So that's why we use the term most appropriate method and not the correct method. Right? Just the way you say true and fair view. Right? So in this particular case, how do you decide? So you take into consideration several points. You think about nature of transaction. You examine the nature of the transaction. Yes, Mansha. Correct. You look at the nature of the transaction. You look at the associated enterprise, the functions, assets, and risk of the associated enterprise. This is known as FAR analysis. Function, asset, and risk analysis. What is the function, asset, and risk analysis? You determine of both the associated enterprise as to which enterprise, you determine of both the associated enterprise as to what are their functions they are performing. whether they are reseller, whether they are service provider, what kind of reseller are they? Are they making value additions? Are they just a normal distributor? What are the assets they are holding? Whether they have any intangibles, whether they have the normal assets, whether they are holding the inventory. So all of these questions you need to ask. What kind of risk are they undertaking? Are they undertaking the financial risk, which is in relation to the interest or the debt borrowed or the credit borrowings which are there? Or are they taking the risk of the inventory they are holding? Are they taking the risk in terms of the market in which they are operating? Are they holding the risk of the bad debts? So all of these questions you need to ask. Ma'am, why these questions? Will they have any impact on the this method to be selected? Yes, certainly. Because by that means you will decide as to what comparable transaction you will select. Because only when you are clear about the FAR of your associated enterprise, you will be able to find out the comparable, independent, uncontrolled transaction. Unless I know who I am, how will I compare myself to others? Unless you know your client well as to whether he's a reseller, what kind of reseller he is, what exactly is this business transaction, until then, how will you identify the comparable gross profit margin? So you need to know the FAR analysis. Third, availability of the data. Whether you have the gross profit markup available, whether you have the net profit markups available, because only when you have the data available, only then you will be able to use the method. Whether you have the comparable parties available. For a reseller, you will compare it to the margin of another reseller who is into similar business model, right? Unless the data is not available, how will you use the method? If you have the cup available, only then you can use the cup method, right? So the availability of the data, the degree of comparability, between international transaction and uncontrolled transaction. Between and uncontrolled transaction. Whether there exists the comparability, or let's say, for example, if I am holding intangible, then I'm not comparable to any other normal distributor which is there, or I'm not comparable to any other manufacturer which is there. So therefore, you have to see whether there is degree of comparability which exists or not. The extent to which the adjustments can be made. Extent to which reliable adjustments can be made. So, if you are able to make certain adjustments or not, let's say, for example, warranty, let's say, for example, discounts, but let's say, for example, if there are certain factors, let's say market is a big factor. If you're operating in Africa versus in India, there could be a big market difference which may be having the impact on pricing. So you cannot select an African reseller. So therefore, you may not be able to make any adjustment for the market. And therefore, you may have to reject the cup method. Right? So therefore, these are the factors you will have to consider. Mansha, which technology we are using as in? Yes, Jacob, you're correct. The nature, extent, and reliability of assumptions required to be made in the application of method. So based on all these questions to be asked, you will decide which is the most appropriate method I will select for my client. Are we getting that? Now, as far as I said, with regard to the comparability of the transaction, you will look at the transaction, the characteristics of the transaction. You will look into the FAR analysis. You will look at the contractual terms between the AEs. Because let's say, for example, on paper, the AE may show that, let's say, the Indian entity is only acting as a back office. But when you look at the conduct of the AE, the Indian entity, you may find that most of the employees are sitting in India. They are in fact doing the majority of the work, and that too they are making the value addition to the work. So you may say that the cost plus method is not a correct approach, or the transaction net margin method is also not a correct approach, because both the entity, let's say the US and the Indian entity, are making the value addition. So you need to look into the contractual arrangements between the party and compare it whether the FAR analysis which you have carried out is in alignment with that or not. Are we clear? Any questions so far? Are you clear about how do we select the methods? Yes, very good question, Mansha. To obtain the data, how do we obtain the data? Is that your question, right, Mansha? How do you obtain the data of the comparables? So for that, there are readily softwares which are available in the market. So you will find out in those softwares, there are these software which is known as ProVes and Capitaline. These are the two softwares which are commonly used for finding out the comparable transactions or the comparable entity. Let's say, for example, if I am reseller, I will first find out the comparable reseller to me. Now, how do I find out? In that particular database, it's a database of the publicly available companies whose data is available. So you have their annual reports. They put these annual reports in the understandable format, in the way you can apply filters to that particular data. So let's say, for example, I go to that database. I will first select reseller. I will select the nature of the product as, let's say, sports shoes. So then whatever resellers are available in the sports shoe industry will come. Then let's say I will select that this particular reseller which is there is not having any inventory. Let's say then I will select that the sales of the reseller should be between, let's say, 1 CR to 10 CR, because my reseller is having the sales of 1 CR, or let's say 7 CR. I do not want to compare it to a reseller whose sales are 100 CR. So I will compare it with the scale of the reseller which I am having it, right? So you will put the sales. Then you will eliminate, let's say, for example, the loss-making resellers, because I am a profit-making, so I don't wish to compare it with the loss-making one. Then I may exclude, let's say, the public sector companies. I may exclude the ones who are using the intangibles. So this is how you put the filters, and you come, let's say, to 10 entities. It's not the one entity in practice which you compare with. So you will ask them the question, ma'am, if you say from the database, we may get 10 to 15 entities, do we have to calculate the ALP of each particular entity and then say, oh, this is what we have to use? No. See, most of the time, what we do is, we have been using the TNMM most of the time. In 60-70% of the cases, you use the TNMM. So you get the net profit margin. Yes, you make these adjustments for each of these entities, what you get from the database, in order to make it comparable to you. You may be making several adjustments to their net profit for accounting differences. Let's say, for example, you will remove foreign exchange gain or loss, because that is a non-operating income or non-operating expense. We consider the operating income or operating expense for the purpose of the TNMM. The foreign exchange gain or loss is non-operating. Interest expense is considered as non-operating. Or interest on FD is considered as non-operating. So you will remove all those differences. You will make the adjustment to come to the operating method. And you will also make certain adjustment. Let's say, for example, the differences in the normal capacity versus the capacity you have. So you make the capacity utilization adjustment. You make the adjustments for certain risk which the other entity is doing. So all these adjustments you will do entity wise. And then you arrive at the ALP, net profit margin. Now you will get, let's say, the 10 ALP margins for the 10 different entities. So then your next question is, how do we consider which ALP is correct? For that, we have to use the range concept and the arithmetic mean. Now, what is this range concept and the arithmetic mean? So either we use the range concept or we use the arithmetic mean. So what is this? Let's try and understand this first. So let's say, for example, if there is more than one ALP is determined. If more than one ALP is determined, and if your method applied is, cup, RPM, CPM, and TNMM. And if your comparable companies, are greater than equal to 6, then you use the range concept. Now you will see, ma'am, what is this range concept? See, transfer pricing is a very subjective exercise, right? It's a very subjective exercise because you may determine ALP as something and I may determine as an AO a different ALP, which could result in the addition to the total income, right? So in order to avoid that, a broad range of transfer pricing is decided rather than coming towards one single ALP. There could be one single ALP, but let's say when you are having a range, it better reflects the result, right? Let's say, for example, even when you are talking about the profit which a company is making, generally, when you do a stock market analysis, what you do is, do you stick at the, let's say, the analysis, the PE ratios which you compute, or the net profit ratios which you compute, or the other analysis which you do, the ratio analysis? You stick to one figure? Do you just pull out, let's say, for example, if I want to invest in Infosys, so I will just compare it with Wipro? No, I will also compare it with other IT companies. Or let's say, for example, if I want to invest in Maruti Suzuki, I will not just compare with Honda. I will compare it with different companies to find out what are the PE ratios of this industry as a whole. So I may get a range. Okay, the car industry has a operating profit ratio of, let's say, 5 to 7% or 10%. They are somewhere in between that. And then you may say, oh, okay, this particular company is performing well, let me just invest in it. Same logic. Here also you will find a range of transfer pricing. And if you're fitting into that range, you are at arm's length price. So a range is given to you. If you fit within that range, a minimum point, a maximum point, if you fit within that, you are at AL. Are we clear? Any questions so far? Are you understanding all of this? Purushottam, for choosing the uncontrollable transaction, it can be with the A. It could not be with the AE because that is a controlled transaction. It has to be with the outsider. Uncontrollable transaction is to be with an outsider. It cannot be with an AE. Clear? So now, how do you calculate the range concept? Let's try and understand. So you calculate the you calculate the weighted average margins or prices for all comparables using 3 years data, including the current year data. So what you do is you calculate the weighted average margins or the prices for all the comparables using the last 3 years data, including the current year data. Let's say, for example, if I have the figure of the gross profit, if I have the figure of the sales, right? Let's say, for example, if I have the figure of the gross profit, if I have the figure of the sales of all these companies from the database. So first I will identify this gross profit margin. And what I will do is I will calculate the weighted average data, which will be, let's say, GP upon sales. So the total GP upon total sales, I will assign the weights, right? And based on that, I will calculate, this will be the first step that I will calculate the weighted average margins for the comparables using the last 3 years data. Let's say for year 1, the GP is 12%. Let's say for year 2, it is 10%. Let's say for year 3, it may be 30%. But what I'll do is I'll add up to all the GPs, I'll add up all the sales and calculate the weighted average. Are we clear? So that is the first step which I will have to take. The second step will be, after I calculate the weighted average data of all the comparables using the 3 years data, I will arrange the prices or profit margins, in ascending order. So once you have calculated the weighted average, you will now arrange the prices in the ascending order. Then obtain the 35th percentile. 35th percentile means total number of comparables into 35%. And you will obtain 65th percentile, which is total number of comparables into 65%. Now this, the number which will come over here, let's say it comes 3. Let's say here it comes 5. So the number, the markup, the gross profit or the net profit, which is there at the third position, that will be your first range. And this will be your second range. So the number on the 5th position in the ascending order will be your second range. This will be your arm's length range. This will be your arm's length range. Are we clear? Let's say, for example, if my arm's length price falls within this range, then I am at arm's length price. In case it does not fall within this range, in case transfer price is not within arm's length range, then you find out the median. Then you find out median, which is 50th percentile, which will be total number of comparables into 50%. So let's say, for example, if the answer comes to, let's say, 3 or 4, whatever, then that will, the number on that particular fourth position will be your arm's length price. Then that shall be your arm's length price. Because let's say, for example, if your transfer pricing is not falling within the range, then you need to make the addition. And for making the addition, you have to consider one of the price. So we obtain the median. Are we clear? Now, let's say, for example, if the answer to this comes in decimal, if the 35th or 65th or 50th position comes in decimal, then how do you select? If decimals are there, then round off to next higher value. Round off to next higher value. And let's say, for example, if it comes whole number, then you take the average of percentile and next higher value. Ma'am, this is very, very confusing. We have not understood anything, isn't it? Yes or no? You have not understood, right? Or you have understood? Yes, fast, write to me in the chat box. Have you understood this or not? Yes or no? Yes or no? Have you understood this? Are you with me? Yes. Difficult, Mansha, okay? It will not be difficult once I give you the sum. Yes, everybody else? Have you understood? Write at least yes or no. Or are you lost in the range concept? Yes, fast. I'm waiting for your answer. Okay, I guess you're lost. Purushottam also somewhat, okay? No, okay, let me make it crystal clear, okay? As we have understood the entire DT, now we are left with only 2 classes of DT, but I hope the rest of the DT is crystal clear to you, okay? Let's write down the question. X Limited, an Indian company, is a subsidiary of XPT Singapore. X Limited has sold raw material amounting to 7,000 units at rupees 9,200 per unit to XPT. X Limited has sold similar raw material to other unrelated entities. The details of comparable are provided below. The total income of X Limited for previous year 22-23 was rupees 9 lakh. Comparable unrelated parties price for previous year 22-23, price for previous year 21-22. A Limited, B Limited, C Limited, D Limited, E Limited, F Limited, G Limited, H Limited, I Limited, J Limited. Okay. Rupees 8990 per unit, rupees 9800 per unit, rupees 9400 per unit, 10,000 per unit, 8,400 per unit, 10,000 per unit, 11,000 per unit, rupees 9690 per unit. No transaction during this year, rupees 8980 per unit, 10,000 again, 11,100, 10,990, 6,000, 9,900, 8,790, 10,330, 7,980 per unit. Now this is the weighted average, which is already given to you. This is the weighted average data only. Yes, look at the question. Tell me what you will start first. Or let me make it simple. Let's just remove this particular one. Let's not consider the last year data. Let's make it very simple. Otherwise, it may be confusing for you. I'm removing the last year data. I'm not putting it. Let's keep it like this. Yes, how will you start first? Yes, nothing for J Limited. Okay, I will put your additional. It's just till I. How will you start first? Yes, Purushottam, we will arrange it in the ascending order. That's correct. So what we will do here is first, but which method is applicable? First, tell me whether these are AE or not. First thing you have to write in exam is, yes, these are AE because this is a subsidiary holding company. Then you will write about the international transaction. So purchase sale of goods is international transaction. Then you will write your most appropriate method. Here is the cup method. Why? Because here you have the direct pricing which is available. And since here comparable companies greater than equal to 6, so we will use the range concept. This is how you will start your answer. So first step, arrange in ascending order. So 1, 2, 3, 4, 5, 6, 7, and 8. Okay. I have let's say first company which I will take is 8,400, which is which company? C Limited. Then I will take 8,990, which is which company? A Limited. Then I have 9,400. That is which company? B Limited. Then 9,900. H Limited. Then I have 10,000. F Limited. Right? Then I have 10,330. I Limited. Then I have 10,990. F Limited. And finally, 11,000, which is D Limited. What is the next step? Yes, what is my next step? Kaushiki, I've already said this is weighted average margin. This is a weighted average data which is given of year 1. Yes, Mansha, this is already, we have only data of 1 year. I'm not taking 3 years for the time being, but this is already weighted average. No, Jacob, we don't need to do weighted average like this. You don't need to add all prices and take average. No, that's not the correct. Yes, Kaushiki, 35th percentile. So, weighted average sum also we'll do, but time being, I'm just explaining you the range concept. Second step is my 35th percentile. So, 8 comparables into 35%. This is 2.8. This is a decimal. So, what I'll do? This is a decimal. Yes. What is 35th and 65th percentile? Yes, Kaushiki, correct. So if it is decimal, what do? Next higher value. Correct, Kaushiki. So if it is decimal, I will round off to next higher value, which is 3. And the number on the third position is 9,400. Then next is 65th percentile. 8 into 65%. How much does it come to? 5.2. So what will be my 65th percentile? What will be my 65th percentile? $10,330. Yes, correct. So you will round off to 6. And the number at 6 is 10,330. So my ALP range is 9,400 to 10,330. What is my transfer price? My transfer price is 9,200. My transfer price is 9,200. Is it falling within the range? Is it falling within the range? Yes. Is it falling within the range? Is it at ALP? Yes, no. So what do I need to do, Kaushiki, then in that particular case? What do we need to do? '50th percentile. Yes, Jacob, not falling. So we need to do the 50th percentile. So here what will be my 50th percentile? This is not at ALP. So I need to obtain 50th percentile. So 8 into 50%, this is coming to 4. Now what do I know? Here it is coming as 4. What do I do now in this situation? How should we proceed? Yes, fast. Yes, everyone. What should we do in this particular case? Fifty-eighth percentile, what should we do, bud? Faster? Yes. So I'll have to round it off to 5. I have to round it off. Sorry, not 5. I have to do here in this particular case, since it is a whole number. What did I tell you for the whole number? For the whole number, what we need to do is we need to take the average of both the values. So here in this particular case, it is 4. So what I need to do is I need to then, on the 4th place, I don't need to select this. I need to select the average of this, which is on the 4th place, plus the 5th, this. So do I need to do 4 plus 5 divided by 2? No, I need to do 9,900 plus 10,000 divided by 2, which comes to 9950. Now my ALP is 9950 per unit. And what is my transfer price? My transfer price is how much? 9,200. So there will be TP adjustment of 7,000 into 750 per unit, which comes to 52,50,000. So my total income was 9 lakh. Add the TP adjustment, this will give me 61,50,000. Is it clear now? Yes, Kaushiki. So you don't need to take the 5th value, you need to take the average of 4th plus the 5th value. Clear? Yes or no? Fine. Is the range concept clear? Before I explain you the weighted average point, yes or no? Yes or no? Now is it clear? How do you calculate the range concept? Jacob, you need to always add the TP adjustment to the total income because that will be added to your total income because your total income will get increased because of the TP adjustment. Clear? Okay. Okay. Now, I'll give you one more example to understand this. Let's write it down. A Limited, an Indian company, is distributor of sports shoes, manufactured by B Limited, US company, and holding company of A. A then sell goods to independent enterprise in India. It has not added any value to the goods. The RPM was found as most appropriate method. During the financial year 22-23, it earned a gross profit margin of 2% in transaction of products purchased from A for resale. Now we are given the resale price (102 crores), cost of goods sold 100 crores, my gross profit is 2 crores, and GP percentage is 2%. Fine. Now I am given the comparable data. Comparable data of 3 years, including current year. Serial number, name of comparable, year 1, year 2, and this is the current year. 1, 2, 3, 4, 5, 6, and 7 comparables. Name of the comparable, B, C, D, E, F, G, and H. Sales 100, gross profit 12. Sales 150, gross profit 10. Sales 225, gross profit 35. Sale 80, GP 10. Sale 125, GP 5. Sale 100, GP 10. Sale 250, GP 22. Sale 230, GP 26. Sale 250, GP 80. Sale 180, GP 12. Sale 220, GP 22. Sale 150, GP 20. Sale 100, GP minus 9. Sale 100, GP minus 8. Sale 125, GP minus 5. Sale 160, GP 21. Sale 120, GP 14. Sale 140, GP 15. Sale 150, GP 21. 130, GP 12. And sale 155, GP 13. Now what you will do in this case? Yes. First thing what you will do? Yes, Kaushiki, weighted average. So how will I calculate the weighted average? First is the weighted average. Okay. So now what I'll do is, again, I'll write the serial number, comparable, year 1, year 2, current year, and weighted average. So first is B. So how will I calculate, or let me put it here only instead of making another table because it will be too much time to write it. Let's put it here. Here I am putting the weighted average. Yes. How will you calculate the weighted average now? Give me the numbers fast. No, Purushottam, it's not because only it's RPM. It is because here I have the data. In the earlier question, I had told you that that is already the weighted average price. So that's why you did not calculate. In the earlier question, it was already given that a weighted average price is given to you. So that step was already skipped. No, Jacob, you will not start with the ascending order. You will first calculate the weighted average. In the earlier question, if you see, you were given the weighted average figures. I had written on the top. See, this is a weighted average data. So therefore, you did not calculate in the earlier question. Fine. Yes, give me the numbers fast. Yes, fast. No, Kaushiki. Yes, Chekhov, weighted average of gross profit margin. Kaushiki, in the earlier question was not TP 9,000 as per question, but in solution we have taken 9,200. No, Kaushiki. See, we have sold at 9,200. So that was the transfer price and the ALP was 9950. So 9950 minus 9,200, 750 per unit is the TP adjustment which is made in the earlier question. Clear, Kaushiki? Okay, I'll tell you how I have to make the weighted average. Very simple over here. What you need to do is, you need to take the gross profit which is there of all the years. So what is my gross profit? 12 plus 10 and plus 35. 57, right? And my sales are 250 plus 225. 475. So my weighted average profit margin is 12%. My weighted average profit margin is 12%. I have taken total of all these plus total of all divided by total of all this. Similarly, here I will do 10 plus 5 plus 10, which is 25 divided by the total sales. So here what will I get? What is the GP percentage over here? Please give me the GP percentages fast. What is 325, Jacob? Did you understand how do we take the weighted average? Yes or no? 8.2%, Mansha. How 8%? It is coming to 8.2%, right? So what are my total? 25 is my gross profit, and then 225 plus 80. 305. So 25 divided by 305. 8.2% is coming as the weighted average for second one. This is 8.2%. Sorry, here. Third is 9%. Fourth is 6%. Fifth is, how will we calculate fifth? What is for the fifth? Calculate fifth. Yes, fast. Yes, Kaushik, it was 8.2. Third, did you get 9? Yes. Fourth, what is it? 6%. Yes, what is fifth fast? How much you're getting? Yes, that's correct. 6.77%. Yes. Yes, Kaushiki, correct. So this is 6.77%. Yes, for G, how much is it? 11.9%, and this is 10.57%. Is the answer coming like that? Yes. Is it coming like this? Yes or no? Now what you will do as a next step? Yes, okay. Yes, Mansha, very good question. If there is a loss, should we consider? Yes, we will have to consider if it is given as a comparable company. This is selected as a comparable company, so we will not eliminate it. Okay, yes. So what is your next step? You will arrange it in the ascending order. Yes, you will arrange it in the ascending order. So arrange it in the ascending order. What is the ascending order you're getting? So second step is ascending order. So serial number 1, 2, 3, 4, 5, 6, and 7. And what you're getting as per the ascending order, first is how much? 6%. Or first I'll write minus 6.77%. Right? Then you have 6%. Then you have third is 8.2%. Then we have 9%. 10.57%. Then 11.9% and then 12%. Now, how will you calculate the 35th percentile? Yes, give me the answers. How you're getting 9.8, Kaushiki? It's 12, 22, and 20 for E, which is 54. 54 divided by 180, 220, and 120. 180, 220, and 150. 550. So 54 divided by 550. Yes, sorry, it is 9.8. Yes, you're correct. This is 9.8. For E, you are not getting 6, right? You are getting 9.8. So there is a correction there. 9.8%. So then we will have to revise this. This will not be 6. I'll take it here. This will go above. And then here will be 9.8. Anarga, third 8.2. You mean D, right? 22, 26, and 18. 66 divided by 250, 230, and 250. 66 divided by 730. It's 9% only, Anarga, for third. For third, it's correct. It's not 8.2. Okay. Yes. What is the 35th percentile? What is the 35th percentile now? Okay. Sorry, Anarga. Got it. Yes. So 35th percentile is 7 into 35%, which comes to 2.45. Right? This you round off to 3. So on third position, which is the range which is there? It is 9%. So this is my first range point. Then 65th percentile. 7 into 65%. This is what? 7 into 65%. 7 into 65% is 4.55. So I'll go to 5. 10.57%. So my range is 9% and 10.57%. Is my normal gross profit coming within that range? Is my normal gross profit coming within that range? The answer is no. So gross profit is not within ALP range. So what you do, you take the 50th percentile. So 7 into 50% gives me 3.5. I'll go to 4th. So this is my 9.80 is the arm's length gross profit markup. So what I'll do is I'll apply it to my resale price. My resale price is how much? Resale price is, it is given 102, right? So resale price is 102 minus ALP markup 9.8%, which will give me how much? Cost incurred. Sorry, cost of goods sold. ALP cost of goods sold. What is 102 ka 9.8%? 9.8%. 10, right? So this is coming to 10. So this gives me 92. What is the cost of goods sold I have incurred? It is 100. So cost of goods sold incurred is 100. So TP addition is rupees 8. Rupees 8 crores. Are we getting that? Purushottam, there is no background. This is drawn from the international guidance. Your answers are populating to me, Purushottam. Yes. Is this clear? Any doubt, any question? Is this clear? Any doubt? Purushottam, why do we not do like sales into GP divided by total sales for weighted average? No, this is how you have to take the weighted average. Total GP upon total sales. It's not sales into GP divided by total sales. Okay? Kaushiki, no, we can't use range for less than 6 comparable. Anarga, charitable trust will be taken up by me. For some reason, the faculty would not be available. So therefore, it will be taken up by me only, the charitable trust class. Okay? Okay. Now, before we go on to the break, I just want to tell you small thing, which is we have not yet finished. If you see my chart, it was incomplete. So if my method is cup, RPM, CPM, and TNMM, and if my comparable companies are greater than equal to 6, then only I can use the range concept. If my method is not cup, RPM, TNMM, sorry, then, sorry, if my method is profit split method, or if my comparable companies are less than 6. In both these cases, I have to take the arithmetic mean. If the comparable companies are less than 6, then you have to take arithmetic mean. But here also, a variation to ALP is allowed. What is the variation which is allowed? Variation of 3% of transfer price. So a variation which is up to 3% of transfer price, that is allowed. It will not be, considered that it is not in accordance with ALP. Up to 3%, that will be allowed. 3% of transfer price and 1% in case of wholesalers. 1% in case of wholesalers. So 3% generally and 1% in the case of wholesaler. Who is a wholesaler? For wholesaler, a notification was issued as to when we can categorize as somebody who is a wholesaler. So where the purchase cost of finished goods, is greater than equal to 80% of total cost. If the cost of finished goods is greater than equal to 80% of total cost and average monthly closing inventory is 10% or is less than equal to 10% of sales. So if average monthly closing inventory is less than equal to 10% of the sales. Clear? So then in that particular case, it will be considered as wholesaler. If my average monthly closing inventory is less than equal to 10% of sales and cost of finished goods is greater than equal to 80% of total cost. Then if the comparable company is less than 6, you take the arithmetic mean. A variation of 3% of transfer price or 1% in the case of wholesaler is allowed. Now you will not be able to understand this, but we'll take up one more sum after the break, after which even the arithmetic mean concept will be clear. Okay. So let's take a break of 10 minutes and then we get back. Yes, can we start the class? Hello? Hello? Ashok ji? Ashok ji? Ashok ji? Okay, the class is already there. I thought that the break was given. Okay, so sorry. Yes. Let's start with the class. I'll give you one more question on this thing, arithmetic mean, which you will solve by yourself. Okay. Duplex INC, or just let's write DINC, a UK incorporated company, holds 30% stake in D Limited, an Indian company. D Limited sold 500 units of raw material at the rate of rupees 9,700 per unit to DINC during the previous year 22-23. D Limited has also sold similar raw material to other unrelated enterprise. Total income for previous year 22-23 was rupees 7.5 lakh. Comparable unrelated parties price for previous year 22-23. A Limited, B Limited, C Limited, E Limited. Rupees 10,000 per unit, 10,990 per unit, 9,900 per unit, and 10,330 per unit. Yes, what you will do in this case, tell me. What is the ALP past? Yes, it is 10,305, Purushottam, correct. So you have to take the arithmetic mean, which is 10,000 plus 10,990 plus 9,900 plus 10,330 because it's less than 6. So it comes to 10,305. Now, what is your ALP? What is your transaction price? Your transaction price is 9,700. So it is clearly not at ALP. Now you have to see whether it is falling within the tolerance band of 3%. Of 3%, right? So whether it is falling, whether the difference between the transfer price and the ALP is how much? Difference is 10,305 minus 9,700 is 605. And 3% of transfer price is 291. So this is more than that. The difference is more than the tolerance band which is allowed. So therefore, the adjustment will be required. So my total income is 7,50,000, 7.5 lakh. I'll make the TP adjustment, which will be 10,305 minus 9,700 into 500 units. This will give me 302,500. So my total income will be 10,52,500. Is it clear? Yes. Is it clear? How do we calculate the ALP in case the arithmetic mean is there? Okay. Yes or no? Is it clear? Yes, fast. Are you clear about this particular point? How do we calculate? Any questions do you have? Yes. Any questions? Yes. Perfect. Is it clear now? Okay. Now understand one thing. That when I'm doing the range concept, I will do it only when I have the comparable companies more than 6. If I have comparable companies less than 6, then I will take the arithmetic mean. Also in the arithmetic mean, I can take the multiple year data. But the method should be RPM, CPM or TNMM. So for using the multiple year data, I should have the method as RPM, CPM or TNMM. Only when my most appropriate method is this, then I can take the 2 years prior plus the current year data, the multiple year data. 2 years prior plus the current year data I can take. Are we clear? Yeah? Okay. Now we proceed further. Now let's say, for example, this TP adjustment which is there has been made. Fine. The TP adjustment is made. Now the question which arises is that now that this TP adjustment has been made, there is a principle, or this is called as the primary adjustment. This is called as the primary adjustment. Now, what does the law require is, law says that, look, you have made this adjustment, meaning, what is the meaning of this adjustment? The meaning is that you have received lesser amount from your aim with regards to this amount. See, you should have made the sales at, oh sorry, this is I think This was what? Sale or purchase. Here, this is a sale. Okay. So you should have made sales at 10,305. You have made sales at 9,700. Meaning, the difference of 605 per unit is the less amount you have received from A. So the law considers this as deemed loan. You have received less means kind of you have given a loan. That is your receivable. This is your receivable amount. Right? This is my deemed loan, which is receivable. Now, if it is my deemed loan, the law says to repatriate this amount, repatriate the amount within the period of 90 days. Law says you repatriate the amount within the period of 90 days. In case you do not repatriate, we will calculate a notional interest on this deemed loan. We will calculate the notional interest, which is called as secondary adjustment. So the law considers that this amount which is not received by the A to the extent of the primary adjustment, we will consider this as deemed loan. It is receivable. We will calculate the notional interest in case you do not repatriate the amount within 90 days. So what the law is trying to say is that you adjust your tax books as per the actual books you have. The law is very clear. It says you have made this addition in tax, but you may not receive this amount in actual. So we will consider this as the loan. Are we getting it? So just write down secondary adjustment. Section 92 CE. Secondary adjustment, where the Indian company has the transaction with the non-resident A, and the transaction is not at ALP, and the transaction is not at ALP, then resulting in decrease in the total income or increase in loss, not resulting in decrease in total income or increase in loss, or resulting in, you can write down, sorry, transaction is not at ALP. Okay, let's remove this, otherwise it will create confusion. The transaction is not at ALP, then you make the primary adjustment, which is your ALP minus the transfer price or the transaction price, right? Now this primary adjustment should be more than rupees 1 CR. The primary adjustment should be more than rupees 1 CR. If that is the case, you make then the secondary adjustment. If the primary adjustment is rupees more than 1 CR plus not remitted to India within 90 days. Not remitted to India within 90 days. So then you make the secondary adjustment. Are we clear? So what is the primary adjustment? Primary adjustment means the difference between the transaction price or transfer price minus the arm's length price. And if it is more than 1 CR, then you make the secondary adjustment. What is the secondary adjustment? Secondary adjustment means adjustment in books of accounts of assessee and its AE to reflect the actual allocation of profits between assessee and AE and is consistent with ALP determined as a result of primary adjustment, thereby removing the imbalance, between cash profit and tax profit. Clear? So that is the meaning of secondary adjustment. Now, when will the secondary adjustment will be made? This will be made when primary adjustment is suo motu made by assessee in his return of income. When the primary adjustment is made by AO and is accepted by assessee, where the primary adjustment is determined by an advance pricing agreement. Advance pricing agreement, we'll learn in a while what is that. Where the primary adjustment is made as per safe harbor rules. This also we will learn in few minutes. And where primary adjustment is made by way of mutual agreement procedure. All of this we will learn it in a while. Okay. Are we clear? Now this 90-day period has to be calculated from what date? This has to be calculated where the adjustment is made by the assessee suo motu, then 90 days from due date of filing return of income under section 139(1), where the adjustment is made by the AO. Adjustment is made by the AO, then from the date of order, date of the assessment order. When it is made under APA, then again due date of filing return of income under section 139(1). Similarly, for safe harbor also due date of filing return of income, and for MAP also due date of filing return of income. Clear? Now, what will be the interest which will be calculated? So the notional interest will be, if the transaction is denominated in INR, then it is 1 year cost. If the transaction is in the INR, then it is 1 year marginal cost of fund lending rate of SBI as on 1st April of the previous year, plus 325 basis point. If the transaction is in Forex, then 6 months LIBOR as on 30th September of the previous year plus 300 basis points. Okay. So the notional interest, if the transaction is in INR, then you take the SBI rate, and if it is in Forex, then you take the LIBOR. Clear? Now, there is one more provision which has been introduced in the last year. What is that? In case the excess money is not repatriated, if excess money is not repatriated within 90 days, then the assessee has the option to pay additional tax at the rate of 20%, or you can write, sorry, not 20, it's 20.9664%. How does it come? 18% plus surcharge of 12% plus 4% cess. So instead of paying the interest, instead of paying the tax on the interest, the assessee has the option of paying the 20.9664% on the excess money. And if he pays this tax, then he will not be required to make the secondary adjustment, and he can just finish off and pay this particular tax. No secondary adjustment will be carried out. Then no secondary adjustment will be carried out. Are we clear? Yes, Mansha, very good point. LIBOR has been replaced with the SOFR. Now, what is the SOFR? SOFR is now used in place of the LIBOR rate. It is the secured overnight financing rate. So it has replaced the LIBOR, but in the law, in the income tax law, we are still using the LIBOR, at least for the secondary adjustment. Though for the using the cup method, we take the SOFR, but at least for the secondary adjustment, we are still using the LIBOR. Correct observation. Very good observation, Mansha. So the law provides still the LIBOR rate. Okay, but if you get the cup to be selected for the interest benchmarking, then we have the option of taking the SOFR. Okay. Is this clear? Is this clear? Any doubt? Any question? Will you solve one question on this so that you understand it well? Very quickly, let's write down. This is a past exam question. ABC Limited is an Indian company in which APT Singapore holds 30% shareholding and voting power. During the previous year, 22-23, Indian company supplied laptops to Singapore company at the rate of $800 per piece. The price of laptop supplied to unrelated parties in Singapore is at the rate of $1,200 per piece. During the course of assessment, or during the assessment, the AO made primary adjustment of rupees 130 lakhs. Difference between transfer price and the ALP for 500 pieces. And it was accepted by assessee. So you are required to explain the effect of this transaction. Assume that total income is 250 lakhs and $1 is equal to rupees 65. Marginal cost of lending rate of LIBOR, or you can just write LIBOR rate. LIBOR is LIBOR as on 30th September 2023 is 2.60%. Yes. What will you do? Yes. What will be the secondary adjustment? Please calculate fast. Yes, Purushottam, very correct. So what you will do is, here it's very simple question. What I'll do is, I'll take this 250 lakhs, which is there, right? Total income is 250 lakh. And secondary adjustment will be 130 lakh into 2.60 plus 3%. 300 basis point, right? So that will give me 7.28 lakh. And my total income will be 257.28. Are we clear? So it's a very simple question. ALP minus TP is less than 1 CR. There is no secondary adjustment, Jacob. No. Here there is no question of calculating the additional tax. Here I have not asked you to calculate the additional tax. In case you have to calculate the additional tax, then this will be on 130 lakhs into 20.9664%. Yes, then you're correct. In case you have to pay additional tax, it's 2725632. So you have the option of either paying this amount, the 7.28 lakh, or you pay the additional tax of 2725632. On this, the tax rate will be what? What is the tax rate over here? What is the tax rate over here? What is the tax rate? Kaushiki, this is last 6-month LIBOR only. As on 30th September, this is the 6-month LIBOR which is given. We can write here 6-month LIBOR. This is 6-month LIBOR. What is the tax rate, guys? Very simple question. You're giving the complex answers but not giving simple answers. The tax rate here will be 30% as applicable to a company. This is the optional additional tax. Now, in case you want to pay the tax as this, or you go and pay the secondary adjustment until you repatriate. Let's say, for example, this company, this is previous year 22-23, right? Let's say in previous year 23-24 also, it does not repatriate the 130 lakh. So then in that particular case, what we will do is, we will pay the tax on, we will calculate the interest on 130 lakh plus 7.28 lakh. So next year, you will pay the interest on the 130 lakh plus 7.28 lakh. Are you getting that? So in case you are not paying the 130 lakh back in the next year, you will be calculating the interest on this particular amount. Are we getting that? So you'll be calculating the interest on this particular amount. Clear? Any questions? In case you pay it out, then there will be no interest. In case you pay it out, then there will be no interest. Is that clear? Is that clear? Yes. So in case, let's say, for example, in the next year, I pay off this entire 130 lakh, then there will be no interest. Otherwise, in the next year, if I don't pay 130 lakh, then I will have to pay 130 lakh plus 7.28 lakh into LIBOR plus 300 basis point. Clear? And then again, you will have to pay 30% tax. Instead, you can pay the optional additional tax and you don't repatriate the amount. Is it clear? Yes or no? Fast, fast, fast. Clear? Is secondary adjustment clear? Yes or no? And what about the tax in the next year if tax paid? In case you pay the additional tax, then there is nothing in the next year, Kaushiki. Okay. So this, if you pay, then no need to repatriate primary adjustment. I want answers from everybody. Yes, Jacob, Geeta, yes. Analga, fast. Tell me, are you clear about this? Yes, Viraj. I don't know who others would be attending, but I know these people regularly participate, so I'm taking your name. Yes, Geeta, Anarga, Mansha, what about you? Have you understood? Okay. Now, the next one is, next particular important topic, what we have to deal is limitation of interest deduction. Section 94B. Limitation of interest deduction under section 94B. And then there are just procedural topics which we will finish off very fast. Even if we are not able to finish off in this class, we can definitely do it in the next class before we begin the charitable trust. Okay. So what is this concept? Now, perfect, Anarga. What about you, Mansha? Have you understood? Yes? Okay. So let's refresh our mind and understand what is this. See, if say I want to raise the funds. I am a company, Indian company. I want to raise the funds. What are the options? How can I raise the funds? Yes, good, Mansha. How can I raise the funds? Yes, Jacob. How can you raise the funds as a company? What are the options available to you? Yes, fast. Issue of shares, debentures. Yes, Purushottam. Correct. What are the other options? Term loan, Viraj. Yes. Preference shares. Yes. So basically, you can raise the funds either through the equity or through the debt. Right? These are the only options. Now, can you tell me, now you know income tax very well. I've heard that you have studied income tax very well. Yes, Viraj, rights share, which means equity only. So, yes, Jacob, issue of share, borrow loan. Now, I learned from somebody that Viraj, Mansha, Kaushiki, Anarga, Geeta, all of these people, Purushottam, know tax very well. And I've come to you to advise me as to which is the best option to raise the funds, equity or debt. What should I do? Whether I should raise the funds through equity or I should raise the funds by borrowing, by raising through debentures or through the bank loan, term loan. Yes, debt is the best option, Purushottam. Why? Why do you think, Purushottam, debt is the best option? Kaushiki says debt saves tax. So you are helping your client, right? But your client is going to be in trouble, Purushottam. Interest allowed as deduction. Because Jacob says debt because we get tax benefits. So all of your client will be in trouble if you advise like this. Because you have now not studied the last part of your syllabus. So that means do not skip any portion from income tax. If you skip anything, not only in exam you will face problem, but you will not be able to advise the client fully, right? So Mansha, you are saying debt is recommended when rate of interest is greater than interest, rate of return is greater than interest on debt. Okay. So Mansha is at least not thinking about tax benefit. Okay. So in case you advise like this, your client will be in a big suit. Why, ma'am? What happened? We will get interest deduction. We will be able to reduce the tax base. But that's what government is not wanting. Government knows, all of you have advised all your clients that debt is the best option than equity. So this is called as when the debt is more than the equity in the balance sheet, the balance sheet is known as thinly capitalized. And therefore, this provision is also known as thin capitalization. Because all of you think interest is deductible, therefore let's raise more of debt and less of equity. And debt is not, dividends are not deductible, right? But this will result in the increase in the interest expenditure and therefore base erosion and profit shifting. Because with the more interest deduction, you will be eroding the tax base. So therefore, the OECD had suggested as a part of the BEPS action plan, this particular recommendation that the countries in their domestic law should introduce thin capitalization provision or limitation of interest deduction provision. And India, as a part of this recommendation, introduced section 94B. Purushottam, issue expenses of debt is allowed, but issue expenses of shares is allowed over a period of 5 years. No, debt is not part of capital structure. It is not a permanent structure. Debt you have to repay. Capital structure means that which is a permanent structure. That is the capital field. Clear, Purushottam? Okay. So, this is why this section 94B is being introduced to put a limit on the interest deduction. And when it is applicable, let's try and understand. Where the payer or the borrower is an Indian company or a PE of foreign company, which is not engaged in business of banking or insurance, and it borrows the debt, from the non-resident lender, who is the associated enterprise, and it pays the interest which is greater than rupees 1 crore and claims as deduction in PGBP while computing the profits and gains from business or profession. Number 1. Second situation is when the payer or the borrower which is the Indian company or the PE of foreign company not engaged in banking or insurance, it borrows the debt from a non-resident lender. It borrows the debt from the non-resident lender and pays the interest greater than rupees 1 crore and claims deduction under PGBP. But this non-resident lender is not the A. This is not the A. But here, the A, whether a resident or a non-resident, provides the guarantee. Here, let's say, for example, I have borrowed the funds from, let's say, Citibank, US. But the A has guaranteed on this borrowing. The A has provided the guarantee to the non-resident lender. The A can be resident or non-resident in the situation 2. Then in that particular case, the excess interest will be disallowed. What is the excess interest? Lower of A or B. What is A? A is total interest on debt less 30% of EBITDA, earning before interest, depreciation, amortization, and taxes. So lower of total interest paid less 30% of EBITDA, and B is interest paid to the A. Interest paid to the A. So lower of interest paid or the total interest paid minus 30% of EBITDA. That will be disallowed. Quickly take a sum and let's understand this by way of an example. X Limited, a resident Indian company, borrowed rupees 100 crores from AINC US company at the rate of 9% per annum interest. Loan is guaranteed by BINC US company measures KINC, a non-resident company, holds shares of both X Limited and BINC. KINC has also deposited 100 crores with AINC. Okay, has also deposited 100 crores with KINC. Net profit is rupees 10 crore after debiting interest, depreciation of rupees 5 crore and income tax of rupees 3.4 crore. Calculate the interest disallowance. Fast. Very easy question. Fast, guys. It's so simple. No, Kaushiki, it's not 5.25. What is your EBITDA you are getting? No, Geeta, it's not 18.4. EBITDA is not 18.4. No, Kaushiki. Yes, guys. EBITDA, you have been calculating since CPT. No, EBITDA is not 17.5. Jacob, no. Why are you calculating EBITDA wrong? What is the net profit? How you're calculating EBITDA? What are you adding? Tell me very quickly. What are you adding to the EBITDA? Net profit mein what are you adding? Yes. 10 plus what? 10 is the net profit, right? 10 plus. Yes, Geeta, it's correct. 27.4 crores is EBITDA. 10 plus interest of 9. Interest is 9, right? Tax is 3.4 and 5 is the depreciation. 10 plus 5 plus 3.4 Kaushiki plus 9. It is after debiting the interest also. So you will have to add back the interest. Oh, okay, Jacob. The answer is interest disallowed. No, but that is also incorrect, Jacob. Okay. So my EBITDA is 10 plus 9 plus 3.4 plus 5. So this gives me 27.4. 30% of 27.4 gives me 8.22 crore. So lower of interest disallowed will be 9 minus 8.22 CR, which is 0.78 CR, or 9 CR. Lower of this is 0.78 CR. Fine. So 0.78 CR, which is there, is the interest disallowance. Now, whatever the disallowance I have done, this can be carried forward for a period of 8 years, and in the next year, it can be allowed. So, excess interest disallowed can be carried forward for 8 assessment years. It can be carried forward for 8 assessment year, and the deduction against the income for the next year will be allowed. But also that will be subject to the maximum allowable interest. Why everybody is forgetting to add 9? You have to add 9 also, Jacob, because that is after the interest. EBITDA means before interest. Clear? Is this question clear? Yes or no? Yes? Okay. Kaushiki, B is the actual interest paid, 9 crores. That's what we saw here. B is the interest paid to A. Lower of 0.78 or 9. Yes, Kaushiki. All of you, is it clear? Yes or no? Okay. Clear. Fine. Now, we have done so many calculations, ma'am. Methods. Then you taught us secondary adjustment. Then you taught us today the range concept, the arithmetic mean. Oh my God. So many things, right? Now it's the time to consolidate all of that. So ma'am, you are going to revise it? No, I'm not going to revise it. You are going to revise tonight. So means the lecture is ending? No, the lecture is also not ending. What we are going to do now is we are going to learn about the documentation of all of this. This is so many numbers, right? And transfer pricing is a very subjective exercise. I may select ALP based on RPM. The transfer pricing officer may say, no, TNMM should have been used. I will select ABCD as my comparable company. Transfer pricing officer will reject it altogether and say EFGH are your comparable companies. So transfer pricing is a very, very subjective exercise. Are we getting that? So it's very important to maintain the documentation for transfer pricing so that when the TP assessment happens, you are able to substantiate it. So maintaining documentation is one of the important aspects for the transfer pricing. And in case you do not, then there are hefty penalties, very heavy penalties. So documentation is something which we should not ignore. Now I'll divide the documentation into two parts or three parts rather. Local file, country by country report, which is called as CBCR. And master file. So the local file which is there. Yes, Kaushiki, even when the transaction is at ALP, you need to maintain the documentation because how will you prove to the transfer pricing officer that your transaction is at ALP? How do you calculate the ALP? For that, you need to maintain documentation. So section 92D first talks about the local file. Here, you have to maintain all the agreements, all the contracts with your AE, all the invoices which you have raised on AE, how have you selected a particular method. So contracts, invoices, your books of accounts, your selection of most appropriate method, selection of comparables, calculation of ALP. So that's what you will maintain in the local file. This is called as transfer pricing study report. Now, once you become CA, if a client comes to you, ma'am, we want to get transfer pricing study report ready. So understand that means a local file, which is very, very, very important. And you will find clients in your practical life also will say, no, ma'am, this is not required. Why do we have to maintain local file? Tell them if you do not, then at the assessment stage, you will face problem. So where the value of transaction exceed rupees 1 crore, then you need to maintain the local file. And this has to be maintained for 8 assessment years. This documentation needs to be maintained for 8 assessment years. Are we clear? So AO can, at the time of assessment, call for the records, and at that point in time, you will have to furnish this documentation. Right? So AO may call for these records, and at that time, you have to furnish the TP study report. At that time, you cannot sit and prepare the TP study report. So that is the local file where you demonstrate how you have selected the comparables, from which database, what filters did you use, how did you arrive at these 6 comparable companies, how did you select or why did you select a particular method. All of this you have to maintain. Clear? So this is the local file, which is very simple, but not so simple when making it. It's just simple to understand. Next is the country by country report. Now this country by country report and master file were suggested or recommended by the OECD as a part of BEPS action plan. Why? Because the multinational companies are operating in multiple jurisdictions, but they are not reporting their details in the other jurisdiction. And this was leading to tax avoidance. So multinational companies have so many group companies, but they do not report where they are doing what. And the tax authorities do not get this information, because of which they were able to devise these kind of transfer pricing policies. Therefore, it was recommended that these reports should be mandated for the companies to submit the data to the government. And therefore, CBCR and master file is as a part of that BEPS action plan. India has adopted it as a part of the BEPS action plan. So, section 286. Section 286 deals with the country by country report. Section 286 deals with the country by country report. But what is country by country report? Let's try and understand. The country by country report which is prepared is the overview or is the data about the company in which country they are doing what. So country by country report gives the information about the company's global income, how is it allocated between the different countries, as the name suggests. Country by country report. So MNEs have to report the amount of revenue, profit before tax, income tax they have paid in each jurisdiction. So this is going to give me the country by country data. So data of activities, profit, taxes paid in each jurisdiction. That is by country report. How many number of employees do I have? Taxes, employees, assets in each country. So all of these I have to report it. Business activity. Fine. But who is required to report this country by country report, or who is required to prepare it? So this is applicable for very large taxpayers, where consolidated group revenue, where the consolidated group revenue as reflected in consolidated financial statement for accounting year, for the accounting year preceding the relevant previous year, greater than rupees 6,400 crore. So if you can see, this is for very large company. So let's say I'm talking about previous year 22-23. So I will look into the accounting year prior to this, which is 21-22. Whether it exceeds 6,400 crore. For previous year 22-23 CBCR, I will look into the previous year 21-22 revenue in the consolidated financial statements. Are we clear? And who is required to prepare it? It is to be prepared and filed by parent entity resident in India. It is to be filed by the parent entity if it is resident in India. If a parent entity is resident in India, then it has to file, it has to report in, what is the form? Form 3CEAD. It has to report in form 3CEAD. And what is the time limit? The time limit is 12 months from end of reporting accounting year. From the end of reporting accounting year. Are we clear? So let's say if it is previous year 22-23, then I will have to file by 31st March 24. 12 months from the end of the reporting accounting year. Are we clear? So this is to be filed in 3CEAD. Clear? If let's say, for example, if the parent entity is not a resident of India, if this is no, and if my parent entity is resident of country, if my parent entity is resident of other country. So it is possible that it's a US parent company and I am the subsidiary company in India. Then I do not need to file the CBCR provided no CBCR to be filed in India if there are conditions. What are the conditions? Parent entity is a resident of country with which India has exchange of information agreement. Exchange of information agreement. So parent entity is the resident of a country with which India has the agreement for exchange of information. Secondly, the report is required, the CBCR is required to be furnished in that country. So not only India should have the exchange of information agreement, but that country also should require the parent company to furnish the CBCR. There is no systematic failure. There is no systematic failure in respect of that country. Systematic failure as in that country should be willing to exchange the information. So in that particular case, what will happen? The CBCR is not required to be filed in India. The CBCR is not required to be filed in India. So in that particular case, if the parent company is filing in their own country and that CBCR is exchanged by way of the exchange of information agreement between, let's say, India and US, then in that particular case, I don't need to file CBCR in India. So if the parent company is a resident of country, let's say if it is not, if there is no exchange of information agreement, then we need to file the CBCR in India. Then the reporting is required in India for the CBCR. Are we clear? Are we clear? So no CBCR is required if there is exchange of information agreement, there is no systematic failure, and the CBCR is required to be prepared in that country. In case these conditions are not fulfilled, if not fulfilled, then you need to report in form 3CAD. then you need to report in form CCEAD. Okay. But in case your parent entity is a resident of that country, then no CBCR is required. CBCR is not required. But then in that particular case, you need to report. You need to just report the details of, parent entity and country of which it is resident. This will be as per, within the time limit. The time limit is within or at least 2 months prior to due date of CBCR. 2 months prior to due date of CBCR. So you just need to report that this is your parent entity and this is the country in which it is resident. Are we clear? Yes or no? Is CBCR clear? Jacob, anybody can prepare TP study report. It's not necessarily CA. Okay? Fine. Now the last one is the master file. The last one is the master file which is there. Now master file is again under section 92D. The master file which is there is provided under section 92D. So this is under section 92D. Now what is master file? Now master file which is there, it's a high level overview. So country by country report is the information about each country. And the master file which is there is the overview of the M&E group business. This is the overview of M&E's business. So in the master file, what do you maintain? And here you give the overall information about the transfer pricing practices at the global level. So at the global level, what you are doing, that information you report in the master file. Are we getting that? Now, who is required to maintain the master file? Or you can write down here what information is required in the master file. List of all entities. Then the description of the supply chain of the important products which are there or largest product which are there, service agreements which you have entered, main service providers which you have, main sale which is there. So this is like a brief overview which you give, right? Or the important restructuring, business restructuring you have carried out, which geographical markets you are operating in, what are the FAR analysis of all the entities, overall strategy. So all of this is given under the master file. A detailed description of the or the overview of the arrangements which the entity has at the global level, that is given in the master file. Now, who is required to prepare the master file? Let's try and understand. Now, the master file which is there, here, it is need to be prepared where the consolidated group revenue is exceeding rupees 500 crore. Where the consolidated group revenue is exceeding rupees 500 crore for the accounting year. Not for the previous accounting year, but for the accounting year. Plus, this is the first condition, condition A. Plus, the second condition is, or let me put it like this. A condition plus the condition B is whether the aggregate value of international transaction So both these condition needs to be prepared. This is the AND condition. So it's plus aggregate value of international transaction during the accounting year exceeds rupees 50 crore, or in respect of purchase, sale, lease, transfer of intangible property, purchase, lease, transfer, or of use of intangible. Mind it, it's not tangible or all property, it's intangible property exceeds rupees 10 crore. So either the aggregate value of all transaction exceed 50 crore or the purchase, sale, lease or use of intangible property exceeds 10 crore. So in condition B, it's all, but both these conditions A and B needs to be fulfilled. Then you are required to maintain the master file. If both these conditions are satisfied. Part A and B of Form 3CEAA is to be furnished, or let me write it like this. If both these conditions are satisfied, yes, no. If the answer is yes, then time limit is due date of filing return of income under section 139(1). And the form is 3CEAA part A and B. If the answer is no, you only need to file part A of 3CEAA. You only need to file 3CEAA before the due date of filing return of income under section 139(1). So even if you are not satisfying any condition, you still need to file part A. Clear? MNE is multinational enterprise. Kaushiki. Is this clear? Yes or no? Fine. So local file, master file, and the CVCR. All this needs to be prepared. Is this clear? Yes or no? Fast before we close the session. Yes or no? Fine. And then you also need to furnish the TP audit report duly audited by a chartered accountant in Form 3CEB. In Form 3CEB, which is 1 month prior to the due date of return of income under section 139(1). What is the due date of return of income? 30th November. So this means you have to submit it by 31st October. Jacob, these files are filed online. Local file, you maintain it in a PDF form with yourself. Only when the AO calls for the information during the assessment, you have to submit it. Master file and CBCR, if you see, these are forms PCEAA, PCEAC. All these forms are to be filed online on the e-filing portal. Yes, Geeta, I know it's very lengthy and today it has been a very intense session. We also have to do the penalties, but I think you must be all tired and exhausted. It will not go in your mind. So what we'll do is, before the charitable trust, we will have the transfer pricing assessment and the penalties which are there for non-filing of these particular forms. We will do it. But what I will request you is, before we come to the next class, revise properly. Go through the penalties part, which is there in your module, because we are going to discuss from there only. It's nothing much over there to be discussed. It's just that the penalties you have to remember. Yes, TP audit in addition to all three, Kaushiki. So you have to go through this completely, again revise it, take tomorrow's time, revise entire transfer pricing, what we have done so far. And then again, the charitable trust is very intense, but do not miss the class. I'll be taking it on Wednesday. Okay. So I hope your DT has gone really well. No, Jacob, there are no classes in April. At least as of now, I think your entire portion is getting completed. Thank you so much, Anarga. Thank you, Jacob. Good night. Thank you, Kaushiki. See you on Wednesday. Okay. We can stop the session.